Swap spread. Exploring the role of swap spreads in finance. Agenda. Introduction to swap spread. Components of swap spread. Factors influencing swap spread. Calculating swap spread. Implications of swap spread fluctuations. Definition of swap spread. Understanding swap spread. The swap spread represents the difference between the fixed rate of a swap and the yield of a government bond of equal maturity. Credit risk premium. The swap spread indicates the risk premium investors require for bearing credit risk associated with a swap transaction. Importance in financial markets. Role of swap spreads. Swap spreads serve as critical indicators of investor perceptions regarding risk and credit quality in financial markets. Pricing financial instruments. Swap spreads are essential for accurately pricing various financial instruments such as bonds, derivatives, and loans. Common applications and uses. Risk management. Swap spreads are essential tools for managing risk in financial markets, allowing institutions to hedge against adverse movements. Pricing strategies. Financial institutions use swap spreads to develop effective pricing strategies for various financial instruments, enhancing profitability. Economic forecasting. Swap spreads assist analysts in creating economic forecasts by providing insights into interest rate movements and market trends. Credit risk assessment. Financial institutions utilize swap spreads to assess credit risk, ensuring informed decision-making in lending practices. Components of swap spread. Fixed rate leg. Definition of fixed rate leg. The fixed rate leg of a swap is a stable interest rate agreed upon by the parties involved, applicable throughout the swap's duration. Cash flow predictability. A fixed interest rate provides predictable cash flows, allowing for better financial planning and risk management. Floating rate leg, benchmark interest rates. The floating rate leg is tied to benchmark interest rates like LIBOR or SOFR, which influence borrowing costs. Market fluctuations. The floating rate leg changes over time to reflect current market conditions and interest rate expectations. Benchmark government yield. Reference point for swap rates. The benchmark government yield is crucial for calculating the fixed rate in swap spreads, guiding market decisions. Risk-free rate indicator. Government bond yields are considered the risk-free rate, providing a baseline for evaluating other investments. Factors influencing swap spread. Interest rate expectations. Impact on swap spreads. Market expectations regarding future interest rates significantly influence swap spreads, affecting financial transactions. Monetary policy changes. Anticipated changes in monetary policy can cause shifts in both fixed and floating interest rates. Credit risk and default risk. Understanding credit risk. Credit risk refers to the potential for a counterparty to default on their contractual obligations in a swap agreement. Impacting financial stability. Impact on swap spreads. Changes in credit risk perception can affect swap spreads. Increasing default risk usually leads to wider spreads. Default risk perception. An increased perception of default risk enhances the likelihood of higher swap spreads, affecting market liquidity. Market liquidity and supply-demand dynamics. Importance of market liquidity. Liquidity in the market is essential for efficient pricing and trading, affecting overall market performance. Impact on swap spreads. The relationship between liquidity and swap spreads indicates how market conditions can alter trading costs and profitability. Supply-demand imbalances. Imbalances in supply and demand within the swap market can lead to wider spreads, impacting traders and investors. Calculating swap spread. Understanding swap spread. The swap spread formula helps in understanding the financial dynamics of swap agreements and their pricing strategies. Fixed rate and benchmark yield. The fixed rate and benchmark yield are critical components in determining the risk premium associated with swaps. Risk premium analysis. Market participants analyze swap spreads to assess the risk premium involved in financial transactions. Examples of swap spread calculation. The swap spread is the difference between the fixed rate and the benchmark yield, reflecting market conditions. Example calculation. In this example, the fixed rate is 3% and the benchmark yield is 2%, leading to a swap spread of 1%. Market indicator. Swap spreads can serve as indicators of market liquidity and risk perception among investors. Tools and software used for calculation. Real-time data access. Many tools provide access to real-time market data, essential for accurate swap spread calculations. Analytical capabilities. Software programs often include analytical tools that enhance the accuracy of financial calculations and market insights. Market insights. These tools provide valuable market insights that help traders and analysts make informed decisions. Implications of swap spread fluctuations. Impact on pricing of financial instruments. Swap spreads influence. Changes in swap spreads have a significant impact on the pricing of financial instruments, including bonds and derivatives. Investment decision impact. Investors need to factor in the shifts in swap spreads to make informed investment decisions in financial markets. Influence on hedging strategies. Swap spread fluctuations. Fluctuations in swap spreads can significantly impact hedging strategies, affecting their overall efficiency and effectiveness. Interest rate risk management. Effective hedging strategies are crucial for financial institutions in managing interest rate risk and maintaining stability in volatile markets. Importance of accurate assessments. Accurate assessments of market conditions are essential for financial institutions to develop effective hedging strategies against interest rate fluctuations. Economic and policy indicators. Market sentiment reflection. Swap spreads reflect market sentiment regarding economic risks and future interest rate changes, providing valuable insights. Importance for policymakers. Policymakers closely monitor swap spreads as they provide crucial information for making informed decisions on monetary policy. Analysts' Insight Tool. Analysts use swap spreads as a tool to gauge economic conditions and to forecast potential market movements. Conclusion. Importance of swap spreads. Swap spreads play a critical role in the financial markets, influencing pricing and investment decisions. Calculation methods. Understanding how swap spreads are calculated is essential for accurate financial analysis and forecasting. Risk management implications. Swap spreads have significant implications for risk management, affecting strategies for hedging and investment. Thank you.